welcome to the 7th video in our Get Started video series.
When it comes to equity investing, people typically try to find out the most suitable time before going ahead. So, even after one makes up their mind about mutual fund investing, the biggest roadblock for many investors is
when should they start? Or when is the right time to invest? Mainly because the markets are such that almost always one can find hundreds of reasons that can be a deterrent to investing. As a result, one can keep sitting on the sidelines waiting for the perfect time to enter the stock market.
But is this wait worthwhile? That is what we will explore in this video.
There are broadly two types of equity investors. Those afraid of sharp ups and downs in the stock market and a crash and therefore like to wait and watch. Then there's the other kind, those who want to avoid investing at the market peak and wish to invest when the markets are at a low, as they know buying low and selling high is very rewarding in the long term.
Both the cases are somewhat related, and the common thread that runs across them is the timing of making investments. So, let's first discuss case 1.
For many investors, equity investing and concerns about the current state of the economy, geopolitics, and other factors go hand in hand. But the kind of dynamic, globalized world that we live in, something or the other keeps happening. And it always feels like the end of good times. Remember all the doomsday theories about the year 2012? Well, you don't have to go that far. Even the last 2 years have been pretty dramatic with COVID-19, India-China disputes, and the Russia-Ukraine war.
While your fears during such times are natural, remember that the markets bounce back every single time they are pushed into a corner. Hard to believe? Here is proof.
Look at this graph that depicts the top 5 Sensex falls in the past 15 years and the returns you would have made if you started investing at the peak of the market and continued it through the falling market monthly. It may seem painful to continue investing while seeing your investments go down in value, but look at the returns in the following 1 and 3 years. Clearly, market falls aren't as bad as they seem. On the contrary, they offer some fantastic opportunities to enhance your long-term returns as they help you buy low and sell high over a period.
So the next time you come across any end-of-the-world theory, remember that its fate will not be any different as far as the stock market is concerned. In fact, one should always look at the long-term picture when investing in the equity markets.
If you observe the Sensex chart of daily values, you can find a million reasons to worry about. But looking at it once a year will restore much of your mental peace, and looking only at 5-yearly patterns turns into a blissful sight, isn't it?
So remember, while equity is volatile in the short term, nothing matters over longer time periods of 5 years or more. Now coming to case 2.
While timing the market to enter at a market low and exit at a high theoretically looks very lucrative and simple, the truth is nobody can do it right all the time.
Believers, nobody can do it right all the time, not even legendary investors like Warren Buffett, as it is impossible to predict the stock market.
In fact, most of the time, market would behave opposite to what you think it would do. A recent example is the spectacular bull rally after the COVID-19 crash in March 2020, when most market experts predicted the worst phase for the equity markets.
On the contrary, as a result of timing your investments or waiting for the perfect time, you might stay out of the market on a few occasions, which can cost you very dearly.
As you can see, staying out of the Sensex on just the 10 best days out of about 5,000 trading days in the last 20 years would have reduced your returns by more than 50%.
So, when is the right time to invest in a mutual fund? Well, the right approach is to take this right time question out of the picture, as every time is best time to invest if one is investing for the long term. However, it is recommended to do equity investing regularly rather than putting all your money in one go. But more on that in some other video. Now before we end this video, here is a quick game for all of you. After all, finance should not be boring, right? So the game is called 2 Truths and a Lie. I'll give you 3 statements in which 2 would be true and you have to guess which statement is incorrect. So let's begin.
investors would have earned over 12% per annum returns by investing in Sensex in the last 10 years. People who pulled their money out of the market after the COVID crash in March 2020 benefited vis-a-vis those who continued to stay invested. Staying out of the Sensex on just 5 best days in the last 20 years would have reduced your returns by more than 35%.
In the comments below, let us know which of these you think is the lie. We will reveal the answer in the comment section within the next 3 days. Bye for now. Happy learning, happy investing.